In today's video, I am going to be breaking down 5 amazing stocks that every millennial should look at to invest in that should be set up pretty well for the future. Let's get down and let's check these out. So the first stock is EA, Electronic Arts. Why is this a good play? Well, as we already know, the whole marketplace when it comes to esports and gaming continues to go higher. The market cap continues to become bigger, and there's going to be obviously no stop to the endless games that are coming out into the future. With EA, what you are getting is obviously a hockey franchise that is thriving. They've done NBA in the past, but let's face it, 2K really owns the NBA space. And then, of course, EA also has Madden and, of course, many other titles. It currently pays in 0.5% dividend, so it's not huge. However, if you're able to get partial shares in your trading account, then that dividend you could just reinvest it and then it continues to grow. It does have an average volume of well over 2 million shares, so it should be easy to get in and out of because I really doubt any of us could buy 1 million shares at a single sitting. From there, it does have a PE ratio of 61. You can really only compare that to other gaming companies, and when it comes down to it, we'll just look at that a little bit later. Over the past 5 years, it's performed quite well. It's gone from 80 to 140 in 5 years, which is almost double, but it's not. And at the time of recording this video, it is at $144 or $143.69 a share. Something that has caught my attention recently when it comes to this stock is, of course, the flag style pattern that it's recently broke out of. Because of that, we can kind of draw that line right here, and we can see that it's broken out right about there, and it could continue to go. It's going to be quite interesting. However, at the time of actually editing this video, the stock is currently at $140.48. So it's come down from that recent potential breakout that it had right there. When it comes to dividends, I really like to see if it's been growing, and it's actually just a recent dividend. They were not paying it for a very long time. It's just a recent dividend that they have added in, and it is only 17 cents a share paid every quarter, but that's still pretty good. It's nice to see a company starting to pay a dividend. When it comes to their financials, we can see that they've had 4 quarters that they have beat, and then when it comes to revenue and earnings, we can see that their revenue was not a massive jump over the past couple of years. However, we've seen a massive earnings increase in 2020, which could be potentially from the COVID virus and everyone staying at home. So that's quite interesting. That kind of proves the potential for this business. Next is Take-Two Interactive. This is another good, strong gaming company. And from there, what we are looking at is no dividend at all. However, there is a pretty good average volume. It is currently sitting at $184 a share at the time of recording this video, and it looks pretty strong overall. When you start looking at the PE ratio, it is half of EA, which is quite interesting. So technically this would be a cheaper company than EA. However, that doesn't show the full picture, because when you start looking at inflated PEs or companies with a higher PE ratio, that just means that they could be actually growing at a larger sum than another company. So for example, EA could be growing at a much higher rate than Take-Two. We'll have to wait until we look at the Take-Two's financials, but as the PE sits, it would be implying that EA has a higher than average, or at least a higher chance of actually growing bigger than Take-Two at this time. And as we can see, Take-Two has done quite well recently. It's kind of pulled back a bit. However, if we really follow those lines down, it has had a little bit of a breakout recently. It was sitting at $50 and now it's sitting at $184. So this actually has had more growth than EA over the past 5 years, which could be why their PE ratio is lower, because they've had more growth and the investors haven't bought the stock as much as the price to earnings has, of course, been inflated. And we can see that we've had actually more growth when it comes to Take-Two. So currently, technically, Take-Two could be a better business to invest in than EA. And then we can see that they've also had 4 quarters that they've beaten. They've had solid revenue increases, plus they've had increases in earnings, which means that's fantastic. Next is Tesla, the darling child. Time of making this video, it's up $48 to $1,073. They just recently had that big Hertz order. However, when we start looking at Tesla, at the time of editing this video, it's actually at $1,100. So it's gone up about $30 over the past couple of days. PE ratio is back to where it was a few months ago, well over 300, which is insane. And then we look at the volume, which is, again, just insane. You're talking 19 million shares traded on average a day on $1 million or on $1,000 per share. That's just ridiculous. And then of course there's this massive increase. We got profitability here. We're seeing Hertz orders here. Over here we were seeing continued growth and the chip shortage not affecting them as badly as it is for other manufacturers. It's on a nice, very tight trajectory upwards, which is nice to see. And then when you're looking at, way back here, you're looking at sub $50 stock and now being worth $1,000. Don't you wish you bought at least a couple $1,000s worth of it 5 years ago? When it comes to their financials, they've had 3 out of 4 good quarters. Of course, this fourth quarter of 2020 wasn't the greatest. So could that foretell what happens in the future? I doubt it. There's going to be more and more chips being made coming up soon. They're going to be able to really break through that, I think, from some of the stuff that I've been reading. So that could be a beat. Who knows? But there is that fourth quarter scare that's there. So of course, over the past couple of years, we've seen solid growth year over year, more so in 2020 than in 2019 to 18. However, positive earnings is good, and so far it's looking extremely solid this year. And then there is Apple. Now, when you talk to an older person and you look at Apple, what is the first thing that they usually say? No matter what type of phone you have, it doesn't matter if you have an iPhone like me or if you have an Android. The first thing that an older person's going to say is, oh, you got a fancy new iPhone, even if it's a Samsung. If you've got a new tablet, oh, I just got to go get my iPad, but they've got a Samsung. Everything, for example, a MacBook. An older person may say if you got your MacBook with you, even though it's maybe not a MacBook. Literally, they have created names for their products that are synonymous across all brands just because they are the number one company in the world. And because of that, we really need to look at them and say they are no longer just a computer company. They are a fashion brand. They are a monthly subscription brand. They are literally everything. Apple, Microsoft, and Google, even though it hurts me to say Microsoft, Apple, Microsoft, and Google are, and Facebook, even though, again, it hurts me to say that, are literally able and could probably run the world, and they probably already do, who knows. But either way, when you're talking about these companies that are massive tech companies, they're only going to get bigger into the future. It doesn't matter what Facebook trouble gets in, or what trouble Facebook gets in, or what anything. It doesn't matter. When it comes to it, these companies are massive. They do, however, pay a dividend, but it's not big. And they have massive growth. Once again, when you're looking at a stock that, of course, they've had splits along the way, but you're looking at like a $20 or less than $20 stock now being worth $150. It's just ridiculous over 5 years. And they do raise their dividend as well, which is good. You always want to see a company raise their dividend periodically. And then, of course, when it comes to their earnings, this is what I really care about. Cash is king. They've had 3 really great quarters, 1 beat but not as great as these. And then we've also seen some pretty good revenue growth going into 2020, and earnings, it's not as good as I would have expected considering 2018 was better, but at the same time, still really strong. And then we get to the final stock, which is TD Bank. Now, why am I saying TD Bank? Well, number one, right now, it's the cheapest PE ratio for the big six. However, when you're leaving that aside, you can literally buy any of the big six banks, and there's a reason for it. If you're young, if you're 20, 30, 40, whatever, doesn't matter. When you're looking at their dividend, if you can either reinvest it into the same stock or reinvest into other banks or maybe other stocks like Apple or other stocks into Tesla, for example, which is what I do. I take their dividend and I invest it other places. That's what I personally like doing. That's my favorite thing to do. And from there, I own 5 out of the big 6 Canadian banks, and that's what I do. I invest the dividend into more riskier things. Now, recently, I have changed my lifestyle up a little bit. And my lifestyle is now I run my own business. I've been doing that for the past year and a half full time. And when it comes down to it, I like to try my best to live off of my dividends and then reinvest my earnings that I make from my business either back into the business or into dividend paying stocks. So again, I make more money. It pays currently a 3.5% dividend, but that's kind of a wonky number because they haven't been allowed to increase their dividend, mainly because of COVID. So we have to keep that in mind. I can almost assume that when they are finally allowed to raise their dividend, you're going to see a massive spike in stock price because people are going to say, oh my God, they made that much money. It does trade at over 1 million shares a day as well. So it's a very strong company to invest in as well, which is always very good. However, over the past 5 years, we can see this with pretty much most of the banks that they traded sideways for about close to a 2-year-ish period. However, there are other banks like National Bank, which is, of course, another one of those big 6 banks, and its stock price is kind of like this instead of what we see with TDs. So there was a little bit of a better growth when it comes to National Bank during that period of time. However, at the same time, they still had this massive sell-off, and because of that, what you're looking at is anytime you see a whole drastic market-wide sell-off, that's usually a good time to buy. Now, really quickly, for the people who have not gone through a massive sell-off before, what you're looking at is basically when the market's coming down, you're going to be seeing increased volatility. When it gets to near the bottom, so here was near the bottom, right about here, we've seen a couple of days where we had higher volatility or higher volumes during intraday trading. When you start seeing massive sell-offs like this, that's usually what's called capitulation, and at that point in time is the time to buy. Now, that could just mean that the world's burning and it's going to keep on going down, but at the same time, if you're seeing higher than normal, then it kind of stutters off like that, and then you get one just massive day and then a back-to-back massive day, at that point in time, that's when you start wanting to get buying in. I was personally buying in on CIBC stock when it had roughly a 10% pullback, and that was 110, I think it was sitting at back to 100. And then with CIBC, I bought more at 90, and then I bought more at 85, and that was the day where I loaded up was 85, and then dropped down to about 83-ish, I think, and then it popped way back up, and now CIBC is doing amazing. So if you ever see massive sell-offs market-wide, that is what you're looking for. Now, I'm using, of course, the TD US stock for this exact video for one reason, and that is the dividends. Here we can see that they've increased and then decreased and then increased dividends. Guess what? That is not because of TD themselves. That is because of the currency. They release their dividends in Canadian currency. It gets translated into American currency. So any of those fake stories that say, oh my God, TD lowered their dividend is all BS. That is just because of currency. They did not actually lower their dividend. And we can see that they've done quite well over the last 4 years. They've increased their revenue each year. Cash is king. Of course, they did have a hit on revenue last year. However, look at the earnings. They made more earnings with less revenue, which means that they're going to be more profitable going into the future, most likely. And these are my thoughts on 5 great stocks that you could purchase if you are a millennial. If you've enjoyed today's video, hit that like button, subscribe, and I'll see you guys again next time.